Hi, welcome back to 5 Minutes to Better Books. I'm your host, Miss Denisa, and last week we talked about the cash flow statement and broke it down so it's easy to understand. And today we'll continue to talk about the cash flow statement. If you remember from last week, the cash flow statement is so key to running a successful business. It not only tells you how much cash you have on hand, which is very important, but it ties into all different aspects of your business. Have you ever wondered how a company that, say, generated $1 million in sales can file for bankruptcy? It really comes down to the fact that they don't have enough cash to pay off their expenses. And how does that happen? How does a company run out of cash when their sales are out the roof and they're doing so well servicing their clients? It's either A, because their expenses are way too high, and or they are extending credit to customers and their customers' payments on their invoices don't quite line up or mesh with the time that they need to pay their bills. Let's define a couple of terms. Cash basis versus accrual basis. What is that? What does that mean? If you run your company on a cash basis, essentially, you only recognize revenues and expenses when they have actually been paid. So cash has exchanged hands between you and the other business and vice versa. Accrual-based companies recognize revenues and expenses once an invoice has been generated or a contract has been signed that solidifies that an exchange will happen in the future. So here's a simple example. Let's say you are a wedding planner and you operate on an accrual basis. So you recognize your revenues once the invoice has been generated or the contract has been signed, but prior to cash actually exchanging hands. So you book an awesome wedding for June 1st for $8,000 plus a $2,000 non-refundable deposit. In order to pull off the event, it'll cost you $7,000. So at the end of the day, you've come up, let's see, quick math, $8,000 plus $2,000, $10,000 comes in, $7,000 is spent, you've brought in $3,000. But let's take a closer look. So you take that deposit of $2,000 60 days before the event, so April 1st. During that time, you've also recognized that sale of $10,000. So on your books, it looks like you have $10,000 in sales, but your cash is only $2,000. So during the month of April, you spend that $2,000 securing details, general business expenses, so your cash flow at the end of the month is $0. Although you still have sales of $10,000. On May 1st, the couple owes you 50%. So you collect $4,000 and it's the month of May. 1 month prior to the wedding, you're scrambling, getting everything set, the venue, flowers, the musician, DJ, what have you. You spend $5,000 getting everything ready for June 1st. So in total for the event, you've spent $7,000, but you've only collected $6,000. And during the month of May, you've only collected $4,000 and spent $5,000. So at the end of May, you have a net cash flow of negative $1,000. Does that make sense? Hopefully you've contracted the final payment to be due before or the day of the event. But there are some businesses that they invoice that final amount to be due after the event has ended. So let's say you invoice a couple for the remaining amount of $4,000 to be due in 30 days. You are in a negative cash flow situation until potentially July 1st when they make that final payment. During this time, you have other expenses that need to be paid. You're getting invoiced by other venues or what have you. And this negative cash can quickly turn into a higher negative cash flow because you continue to have to run your business and make payments. And this is all during the quarter when you have $10,000 in sales on the books, but you have a negative cash flow. See how that works? Hopefully that makes sense. I didn't lose you. Next week we'll delve a little bit more into invoicing and how to make it easy for you to get paid. For this week, here are 5 tips on how to better analyze your cash flow statement. Number 1, determine whether you operate on a cash basis or an accrual basis. Number 2, detail when you expect payments to be received versus when your expenses need to be paid. And do those line up? If they don't, then you need to reassess and make sure that they do. Number 3, set up a foolproof invoicing system, and we'll discuss more of this next week. Number 4, review the cash flow statement on a monthly basis. As you can see from this example, it was key to look at, for this wedding planner, it was key for her to look at it on a monthly basis. Number 5, keep it simple by getting a bookkeeping system to run it for you. It'll run the statement for you. It'll eliminate a lot of the manual entering. It'll make it really simple. Hope that helps. See you next week when we talk about invoicing.